All right, let's dive right into this explainer. We're going to break down the step-by-step blueprint for building, running, and most importantly, profiting from your very own banking empire. We're stripping away the Hollywood myths you see in the movies and looking at the actual, hard math that powers the entire financial world.
So you want to buy a bank? Well, to kick things off, we have to look past the movie cliches. You know, the giant physical vaults, the armed guards, the towering marble columns. We need to ask what it actually takes to get the single most valuable license in the United States. The right to take other people's money for safekeeping and then turn around and lend it back out to other people at interest. Here is your exact blueprint for building this banking empire. We're going to cover 1. Getting your own bank. 2. Robbers and real threats. 3. Creating money from nothing. 4. How banks can fail. And finally, 5. Calculating the final payoff. Okay, let's jump into section 1, getting your own bank. You've basically got 2 main paths to get in the game, and honestly, the contrast between them is wild. Starting entirely from scratch, it's a complete administrative nightmare. The FDIC is going to demand at least $20 million of your own capital just sitting there. Add to that another $500,000 just for lawyers and consultants, an exhausting 800 to 1,500 page banking charter, and a grueling 18 to 24-month wait just for regulators to review your application. But there's another way. Buying an existing small community bank is arguably the much smarter route. Take Plumas Bancorp, for example. They recently bought Cornerstone Community for $64.6 million. Generally speaking, for about $40 million, you can swoop in and buy a bank that already has $200 to $300 million in assets. You get instant access to the license, the customers, and a fully trained staff without that massive 2-year wait. Or if you want a shortcut, you could look across the pond to Europe. Specialized banking licenses over there only require 5 to 10 million euros in regulatory capital. Makes total sense why almost every young European fintech startup starts there before expanding globally, right?
Moving right along to section 2, robbers and real threats.
When you picture banking risks, you probably imagine high-stakes heists, getaway cars, ski masks, the whole 9 yards. But the actual data tells a totally different story. The UK sees maybe 100 robberies a year, and the US had about 1,362 back in 2023. But get this, the average take from an American bank, a measly $5 grand, $5,000. We are a long, long way from those millions you see on the big screen.
And because that payout is so pathetic, bank robberies have plummeted by a massive 80% over the last 20 years. It's just not a viable criminal career choice anymore.
But here's the crazy part. Even if a robbery does happen, the bank itself doesn't actually take the hit. A lot of folks assume the FDIC covers stolen money, but they actually only step in if the entire bank goes under. For everyday robberies, banks have a mandatory insurance policy called a banker's blanket bond. Because this theft insurance covers stolen cash, tellers at the counter are specifically trained to just hand over whatever cash is in the drawer with absolutely zero resistance. The logic is brutal but simple. The cash is insured, but human lives are not.
So the crucial takeaway here is that the guy with a gun is a complete cliche. The real existential threat to your new bank comes from the people already sitting inside the office. Roughly 60% of all money stolen from American banks over the past decade was taken by the bank's own employees. Yeah, it's the loan officer quietly writing up a fake mortgage for his spouse. It's the teller slipping a $100 bill out of the drawer every few days. Or, the IT guy who holds the keys to the entire system.
All right, let's get into the real meat of this playbook. Section 3, creating money from nothing.
This single number changes absolutely everything you thought you knew about how a bank holds your money. 0%. In March 2020, the Federal Reserve quietly, completely eliminated the reserve requirement. Before this, banks actually had to hold at least 10% of deposits in a special account. Today, the formal requirement is exactly 0. This means your bank does not have to keep a single solitary cent of a customer's deposit sitting in a special reserve box waiting for them. When a bank lends out money, they aren't pulling physical cash from a drawer. They literally just type the loan amount into the borrower's account. As long as they stay within overarching capital and liquidity rules, they're fully authorized to create deposit money right out of thin air.
So how does this turn into massive profits? It's all about the net interest margin. Imagine a customer deposits 10 grand into a savings account. You, the bank, pay them a standard, let's say 0.5% interest. That's $50 a year. You then turn around and lend that exact same 10 grand out for a mortgage at 7%, collecting $700 a year from the borrower. The bank simply pockets the $650 difference on money it never even had to come up with itself. This 3.5 to 4% margin gap is the exact magic trick a behemoth like JP Morgan uses to pull in roughly $100 billion a year in interest income alone off its $4 trillion book.
And then there's the absolute profit engine that is the credit card trap. Americans currently owe a staggering $1.25 trillion in credit card debt. Banks are charging an average of 21% interest on this, all while borrowing from the Federal Reserve for under 4%. Let's break down the math on a typical $5,000 balance. If a customer makes that quote-unquote responsible minimum payment of $100 a month, because of that 21% rate, 90% of that payment goes straight to interest. Only 10% actually chips away at the debt. At that snail's pace, clearing a $5,000 balance takes 10 years and costs $7,000 in pure interest. In 2023 alone, major issuers raked in an estimated $25 billion in extra interest just by jacking up their margins over their own borrowing costs.
Historically, though, some banks have taken alternative revenue streams to absolute extremes. Take Wachovia Bank back in 2010. They were the fourth largest bank in the US at the time, and they admitted in federal court that their anti-money laundering controls completely failed. Cash from drug sales was being dumped into Mexican currency exchange shops, Campsabios, then wired into Miami accounts looking like normal money transfers. From there, the bank moved the money to buy aircraft and real estate. Wachovia collected fees on a mind-blowing $420 billion laundering scheme without throwing a single red flag. The punishment? They paid a $160 million fine. And jail time? Zero. Not a single employee saw the inside of a cell.
Let's shift gears a bit. Section 4, how banks can fail. Because as an owner, you need to know how to avoid catastrophe.
Look no further than Silicon Valley Bank. Their collapse highlights the sheer, terrifying speed of a modern bank run. SVB was the 16th largest bank in the US, sitting on $210 billion in assets. But on March 8, 2023, they announced an urgent need to raise capital. Now, in the old days, a bank run meant people physically lining up down the street, which gave the bank time to react. Today, it happens on a smartphone. Panic spread like wildfire in private founder group chats. In a single day, $42 billion vanished via mobile apps. Just 40 hours after that initial announcement, the bank literally ceased to exist. Though interestingly enough, CEO Greg Becker managed to sell off $3.6 million in personal shares just 13 days before it all went down.
So to survive this modern landscape, you've got to follow a strict set of rules. Rule number 1, diversify your depositors. SVB died because 89% of its clients were all in the exact same venture-backed tech industries, so they all panicked at the exact same time. Rule 2, be hyper-aware of duration risk. SVB made the mistake of parking short-term customer deposits in long-term government bonds. When interest rates went up, those bonds lost value, forcing the bank to sell them at a massive loss when customers demanded their cash back. And finally, watch who you're lending to. Just recently in 2023 and 2024, hundreds of regional banks narrowly avoided bankruptcy because they were holding commercial mortgages on office buildings, sitting half empty, thanks to the global shift to remote work.
Okay, the moment we've been waiting for. Section 5, calculating the final payoff.
Let's run the actual math and see what happens when you follow this playbook perfectly. Option 1, you stay as a small community bank. You bring in your $20 million in capital. Now you're probably going to operate at a loss for the first 3 years while you scale, but by year 5, you're sitting on about $350 million in assets. Using that 4% net interest margin, you're generating around $14 million in net interest income, which leaves you with roughly $4 million in cold, hard annual net profit. A lot of owners build this up for 10 years and then just cash out, selling the bank to a regional player for 4 times their original investment. But if you're ambitious, option 2 is scaling to a regional giant yourself. We're talking 20 to 30 billion in assets spread across multiple states. At that scale, you're pulling in up to $1 billion a year in net interest income, pocketing a staggering $400 million in net profit every single year.
Honestly, not bad for a business model built entirely on debt, customer data, and interest margins, right? I mean, you take deposits, you lend them right back out at a higher rate, and you just pocket the difference. It's an incredibly powerful system if you can navigate the regulations and dodge the risks. Which leaves us with one final, very important question after crunching all these numbers. Are you ready to take the leap and start selling people their own money back?